Welcome back to Investing Talk Podcast. Today we're diving into a company that's, well, been all over the place lately, Tilray Brands. And we're asking that big question on everyone's mind, especially with growth stocks. Is Tilray Brands a good time to buy right now?
We've certainly waded through a lot of material for you on this one. Fundamental reports, technical charts, even tracking those really speculative catalysts. Our mission really is to pull out the key insights so you can get informed quickly. There's just so much noise around this stock.
Absolutely. And before we jump in, just a quick reminder, folks, please hit subscribe, like this discussion, leave a comment. It really helps us keep bringing you this kind of analysis. And very importantly, if there's a specific company you want us to look into next, just let us know in the comments below.
Yeah, we do read those.
Okay, so let's get into it. The recent action here, it's just been wild. Looking at the chart, Tilray Brands stock shot up nearly 300% since, what, July 2025?
That's right. A huge move.
And our sources are pretty clear this wasn't really about earnings or anything fundamental initially. It seems almost entirely driven by investor hope, optimism about potential U.S. cannabis reform.
Pure regulatory hope, exactly. And that sets up this fascinating conflict, doesn't it? Because you've got this massive stock rally, this tripling of the price. But the actual operating results, they show some pretty significant risks still. It's a classic disconnect we see sometimes.
Okay, so what do those results look like?
Well, the company did report a break-even quarterly EPS back in August 2025. And technically, that beat expectations. Analysts were expecting a loss. So that was seen as positive.
Right, break even sounds better than a loss. But EPS, earnings per share, that's just one number. It doesn't paint the whole picture, does it?
No, it really doesn't. Because while they pulled in revenue of about $209.5 million that quarter, the core engine of the business, their main cannabis segment, actually declined 9% year over year for the full fiscal year 2025.
Ah, okay. So there's the friction point. The main business is shrinking, but the stock's flying high on hopes for a market, the U.S. market, they can't even fully operate in yet.
Precisely. That's the core tension right there.
So how are they managing that? I mean, if the cannabis part is sluggish, what are they doing?
Well, this is where their strategy comes into play. They've leaned quite heavily on diversification. They've got these alcohol and wellness product segments, and they use those to kind of cushion the blow from the slower cannabis sales. That strategy actually allowed them to post a 4% increase in net revenue year over year, hitting $821.3 million for the full fiscal year 2025.
So that diversification is actually working to keep the top line growing, even if just a bit.
Exactly. And that multi-segment approach, that resilience, it's a major difference compared to some of their competitors who are just pure play cannabis companies.
Okay, interesting. Let's connect that diversification to the bigger picture then, the fundamentals.
Right. So this strategy really forms the foundation of the bullish argument. If you look at their trailing 12-month revenue, the TTM figure, it's now up to $830.77 million. And that mix, cannabis, beverage, distribution, wellness, it gives them stability. It's like having a few different legs to stand on, reducing that single market risk.
Okay, revenue stability makes sense, but let's tackle the elephant in the room, that huge loss number. TTM net loss of $2.15 billion, an EPS of negative $2.30. I mean, for anyone just glancing at the number, that sounds terrible. How do the sources square that with a bullish view?
Yeah, and that's an absolutely crucial point to understand. That $2.15 billion figure looks alarming, no doubt, but the sources really emphasize that the vast majority of that loss comes from non-cash impairment charges and also acquisition expenses. It's not like they burned through $2 billion in cash from operations.
Okay, non-cash impairment charges. Let's break that down simply because it sounds like accounting jargon, but it seems key here.
Think of it like this. When Tilray Brands bought other companies or assets in the past, they put them on their books at a certain value. Now, if market conditions change, maybe regulations take longer than expected, or valuations come down, accounting rules, GAAP rules, require them to say, okay, this asset might not be worth what we originally thought. So they take a charge, an impairment charge, to reduce the value on paper.
Got it. So it's essentially a write-down. It's acknowledging that maybe past acquisitions, made when optimism was higher, aren't worth quite as much now on paper. It reflects past decisions more than current operational bleeding.
Exactly right. It doesn't involve cash actually leaving the bank now. Management's focus, they say, is on getting those core segments profitable through better efficiency, getting synergies from those deals. So it makes the loss look more like an accounting adjustment from past investments rather than a sign the current business is collapsing operationally.
That distinction is really vital for context. Okay, so they have this diverse business. What's stopping competitors? What's their competitive moat?
Well, the moat is built on things that are hard and expensive to replicate. First is their regulatory expertise. They've spent years and a lot of money getting licenses and building infrastructure in regulated markets around the world, especially Europe. That's a huge hurdle for anyone new wanting to enter. High barrier to entry, right?
Right. You can't just flip a switch and have operations in Germany, for example.
Exactly. Second is their brand portfolio strength. Particularly in the beverage segment, they bought established craft beer brands. That gives them instant consumer recognition and, crucially, channels for potential cross-selling if and when cannabis rules change more widely.
Makes sense. Leverage what you already have.
And the third piece, often overlooked, is their geographic diversification. Unlike a lot of North American cannabis companies, Tilray has significant operations in Europe and other emerging markets. This global footprint means they aren't entirely dependent on, say, U.S. politics playing out perfectly. It reduces risk and gives them multiple avenues for growth.
Okay, that paints a clearer picture of the fundamental case. Now let's shift gears. Let's talk technicals. This is where the traders are really focused, given that huge run-up.
Yeah, the technical picture is where things get really interesting right now. The stock currently around $1.72 as of October 2025. And remember, it came all the way up from a 52-week low of about 35 cents. So a massive recovery. What's important is that the market seems to have built a really strong base, both psychologically and technically, in this, say, $1.50 to $1.80 range. It suggests this upward move has some real conviction behind it.
And here's where it gets, well, almost textbook bullish for the technical traders, right?
Yeah.
The stock is trading above all the major moving averages. We're talking the 10-day, the 20-day, 50-day, 100-day, and the 200-day.
Yeah, you don't see that perfect alignment very often. When all the averages are stacked like that, with the short-term ones above the long-term ones, it's a powerful signal. It shows short-term momentum is reinforcing the longer-term trend. Every single one of those MAs is flashing a buy signal right now.
That's pretty compelling confirmation, and it's not just the price averages, is it? What about the strength of the trend itself?
That's confirmed too. The ADX, which measures trend strength, the average directional index is really high, up at 46.32. A high ADX like it doesn't just say there's a trend, it says there's strong conviction behind that trend. Buyers are firmly in control here, technically speaking.
So, putting it all together.
Well, when you aggregate all the technical indicators the sources track, I think there's 17, they look at the overall summary comes out as a strong buy. It's based on something like 12 individual buy signals. For traders focused on momentum, that's pretty undeniable evidence that market sentiment has done a complete U-turn.
Okay, so if the momentum's that strong, where are the technicals pointing? What are the targets?
So immediate resistance levels to watch are the psychological $2 mark, and then probably stronger resistance around $2.30. Looking short term, say the next 0 to 3 months for active trading, the base case target seems to be in the $2.20 to higher $2.80 range.
And if things really go well, if catalysts hit?
Yeah, if the bull case plays out, driven by some of the catalysts we'll talk about, that target could stretch up towards $3, maybe even $3.50 relatively quickly.
All right, let's talk about those catalysts then, because technical momentum is great, but it needs news, it needs fuel to keep going.
Exactly. And there's stuff on the immediate horizon, and then there's the bigger, more speculative stuff.
Okay, what's coming up soon? What should people be watching in the next, say, 3 months?
Right, immediate visibility. October 15th, we've got their Q1 earnings release. That's going to be critical for sentiment. Can they keep that break-even EPS momentum going? Then October 28th, there's potential for ETF rebalancing. After such a huge run-up, some big funds might need to adjust their Tilray holdings, which could cause some short-term volatility.
Okay, what else?
November 27th brings a holiday consumption update. This could provide some seasonal good news for their beverage and wellness segments, which tend to be more stable. And then December 15th is when we start seeing the institutional 13F filings. That gives us a look at where the big money, the whales, place their bets during this big rally.
So, a few things to watch for news flow. But the real excitement, the reason the stock moves so much is the bigger picture stuff, right? The speculation.
Absolutely. That's where the potentially transformative potential lies. Number one, without a doubt, is U.S. federal cannabis legalization, or perhaps more realistically in the near term, rescheduling. There's renewed buzz, strong speculation about moving cannabis from Schedule Y down to Schedule 3 under the Controlled Substances Act.
Okay, let's pause there, because Schedule 1 to Schedule 3 sounds technical, but why is that so important? It's not just changing a number, is it?
Oh, it's everything. It's potentially game-changing. Right now, because cannabis is Schedule 1, companies like Tilray, when operating where it's legal, are subject to Section 280E of the tax code. 280E is brutal. It means they can't deduct normal business expenses, rent, payroll, utilities, marketing from their federal taxes. Think about that. Every other normal business deducts these things.
So they're being taxed on their gross profit, not their net profit after expenses. That must kill profitability.
It absolutely crushes it. Moving to Schedule 3 would likely eliminate the 280E burden. Overnight, their profitability profile transforms. It frees up enormous amounts of cash. And just as importantly, it would likely open the doors to standard banking services and much broader institutional investment, which are largely off-limits now. This single regulatory shift is the biggest potential catalyst. Full stop.
Wow. Okay. That clarifies why rescheduling is such a huge deal. What other speculative drivers are out there?
Well, there's always M&A chatter. Rumors persist that Tilray might be looking for a big, transformative deal, maybe acquiring or merging with a U.S. company, perhaps in beverages or wellness, to get scale and distribution ready for potential U.S. market entry.
Getting positioned ahead of time.
Exactly. And finally, there's international expansion, particularly focusing on Europe and specifically the German adult use market finally maturing. Tilray already has significant infrastructure there, so they're well positioned to capitalize if that market develops as expected.
Okay, lots of potential upside drivers. But let's ground ourselves again. This is clearly a speculative play with that kind of catalyst list. We need to talk about the risks. And the first thing, just technically, is the beta. It's high, 2.13. So for you, the listener, that means this stock is volatile. Way more volatile than the overall market. If the market hiccups, this stock could really drop sharply.
That high volatility is definitely the cost of entry for chasing this kind of potential upside. You're absolutely right. And beyond market risk, there are company-specific risks you have to weigh against those catalysts. The big one is still the path to sustained GAAP profitability. When will they actually start making consistent profit on the bottom line? That really depends on realizing those synergy savings they talk about from past deals, and crucially, the timing of any regulatory changes. That timing is completely uncertain.
And what about dilution? They have a lot of shares out there already.
That's another key risk. Over 1.12 billion shares outstanding. That's a huge number. If they need to raise more money for growth or just to bridge the gap until they are profitable, they might issue more shares. And issuing more shares dilutes existing shareholders, potentially putting pressure on the stock price.
Right. And the final big one is just the ongoing regulatory hurdle itself, isn't it?
Yes. Until U.S. federal reform actually happens, their operations and the entire sectors remain subject to these really complex, unpredictable, and often costly legal environments. That uncertainty hangs over everything.
So it really boils down to this core challenge for you as an investor, doesn't it? You've got these powerful speculative drivers, incredible technical momentum right now, but you have to weigh that against the reality today. A core business segment with stagnant growth and these persistent net losses, even if they are mostly non-cash accounting losses, it's today's fundamentals versus tomorrow's potentially huge payoff.
That's the tension perfectly summarized. And synthesizing all the source material we looked at, the overall rating comes out as clearly bullish, an 8 out of 10. The rationale is basically that Tilray gives you established exposure to the global cannabis market's potential, but it's combined with that stability from their growing beverage and wellness diversification. It's not just a pure cannabis bet anymore.
So how should you think about the time frame then, based on all this?
It really depends on your own risk tolerance and how long you're willing to wait. Short term, say the next few months, the setup looks attractive for active traders. They'd be looking to play the momentum, the upcoming catalysts, targeting that $2 to $20.80 range we discussed.
But for the long haul.
Long term, like 1 to 3 years or even more, that's where the potential for truly transformative multi-bagger returns exists. Analysts throw out numbers like $10, $15, even $20 plus per share. But, and it's a big but, achieving that requires real patience. It relies heavily on major U.S. federal reform actually happening.
Okay, so maybe we can leave our listeners with a final thought to mull over.
Yeah, here's something to think about. If those rumors about rescheduling cannabis from Schedule 1 to Schedule 3 in the U.S. do come true, and that 280E tax burden just vanishes, how fast would those sudden, massive operational efficiencies, basically, a huge boost to profitability, close the gap between today's price, around $1.72, and some of those really aggressive, bullish analyst targets? It suggests that right now, even after the big rally, the market is still pricing in almost zero certainty that this fundamental game-changing shift will actually occur. That's the bet investors are making.